All right, greetings to you, faithful Herle Burlyites. I've got big news about your favorite Canadian political podcast. Come the end of February, we're taking this show on the road. That's right, we'll be podcasting at you, not from downtown Toronto, not from Denholm, Quebec, but from the warmer climes, the sunnier climes. There isn't a convoy clogging up the middle of the downtown core climes of Uvita, Costa Rica. More specifically, from my brother's house in Uvita, Costa Rica, overlooking the whale's tail. What does this mean in terms of our podcast content and schedule? Nothing at all. What does it mean in terms of my personal happiness and the ability to end my day with a parasol in my drink and a richly colored toucan in the vicinity? Goddamned everything. As we know, a happier Herle Burly is a better Herle Burly. That's what my therapist tells me anyway. All right, today on the show, a guest we've been wanting to talk to for a good long while now. It's Peter Routledge. Mr. Routledge is the Superintendent of Financial Institutions for the Government of Canada, appointed to that position in June of last year. Prior to that, he served as President and Chief Executive Officer of the Canada Deposit Insurance Corporation and led a complete transformation of its culture and vision. He's also been a senior advisor at the Department of Finance, working on a wide range of policy issues, and before that, in the private sector with the National Bank, among others. Today, we're going to talk about his mandate, what OSFI does, and we're going to talk specifically about housing, cryptocurrencies, and climate. Welcome to the show, Peter. Thanks for coming on.
Thank you, David. Great to be here. As I said before, I'm a longtime listener and privileged to be here to speak with you.
Yeah, well, that's amazing that you listen to the show, so thank you very much. Yeah. Thank you very much for doing that. How are you these days? Where are you at?
I'm in Ottawa. I'm at my house in Ottawa. After the arrival of Omicron, we decided to close our offices for the month of January, and we're pausing it 1 week longer to let the demonstrations run their course, and then we'll be back at it next week or the week after.
Right. Has your life been disrupted by this demonstration at all?
Not at all. Although our offices, the building that our offices sit in, were vandalized. We had broken windows and boarded up windows. So kind of shocking.
Really?
When it happens
by people that are angry about vaccine mandates. They broke your windows. Yes,
they did. But, yes. They're repaired and we'll be fine.
Hey, Peter, what part of the country are you from originally? Where do you come from?
Well, I was born in Montreal. But at 4 years of age, my parents up and moved us out west, and we started in Seattle. I lived about 10 years in the States, and then we moved back to Vancouver, and I did high school and university in Vancouver. So I'm from the West, and I'm from Vancouver. My mom and brother still live out there, as does the family of my wife.
What years were you living in Vancouver?
I lived in Vancouver from about 81 to 95 with a 2-year pause in the early 90s in Toronto.
Okay. You saw some good Canucks years in that time.
I did. I was in Vancouver in 94 for the Stanley Cup run, and that was thrilling.
Herle Burly, one of the most exciting players I've ever seen.
Yeah, it was a great run. And then I remember being back in Vancouver in the spring of 2011 for the 2011 run, which also ended in tears, but my fidelity to the Canucks remained undiminished. My dad was a Canadiens fan, so I'm also a closet Canadian fan.
Well, there you go. That's your connection to the pod right there.
Yeah, right there. Yeah.
As I mentioned in the intro, you were in the private sector before you got into government, right?
Yeah, I was for about 20 years. Yeah.
How do you compare the two? What's the transition like, and what do you gain and what do you lose?
Well, what bluntly put, what you lose isn't that bad as it turned out, although at the time when I was making the decision, it seemed big. It's compensation. You take a pretty sizable pay cut. What you gain is the thrill of working for your country. And that sounds a little bit sentimental, but that's why most people in the public service work in the public service to serve their country. That's the advantage if you're leading an institution in the public service. The motivation and the morale benefits you get from saying we're doing something for Canada and for the country is enormous. It's an advantage you don't have in the private sector. I can tell you altruism is a better motivator than compensation.
That is the coolest thing. Thank you for saying that.
Yeah.
Godspeed to more people making the decision that you made. So there isn't a more boring title in the world than the Office of the Superintendent of Financial Institutions. There isn't a word in that title that doesn't start to put you to sleep.
Yeah.
OSFI, the Office of the Superintendent of Financial Institutions. What does it do?
Well, we supervise all federally regulated financial institutions in Canada. And so what are those? Those are banks, federal credit unions, trust companies, life insurance companies, general insurance companies, and private pension plans. And
Who doesn't it include? Who doesn't it include?
It doesn't include provincial credit unions, so credit unions that were regulated by the provinces, and some provincially regulated insurance companies. But other than that, it pretty much covers the waterfront. And we supervise the institutions, institution by institution. It's fairly granular. Think of us as the police for financial institutions. And we practice or try to practice community-based policing. So policing where we engage, talk to folks about our principles and our expectations, and have a continuing dialogue.
Okay, so can you make that practical for me? What does that mean? You both set the rules and enforce the rules, correct?
The government will set the rules through the Bank Act, through the OSFI Act, the Insurance Company Act. We enforce them. We then also add regulations on top of it, which we do. And so there's a group at OSFI that looks at the risks on our horizon and says, well, we need to change our rules or expectations this way, and often we'll document them in the form of a regulation, and away we go. And then there's a huge team that supervises each institution. So if you think of a big bank, think of your bank that you do your banking with. If it's one of the larger banks in Canada, there's a team of roughly 10 to 12 every day watching what they do and making sure that the banks remain in sound financial condition. You asked, or you mentioned...
Without naming a financial institution, what is a thing that a financial institution might try to do that you would stop them from doing?
A great example is borrow to, or to lever up. Lever up's the technical word. To borrow more money against their capital base to make loans. And so what we do is we say, nope, you can only borrow this much against your capital base because that's the buffer that protects the bank from failing. And so if you want, after a certain level, if you want to make more loans, get yourself more capital, whether through earnings or whether through an equity raise, get yourself more capital. That's basically what we do. There are other rules, like we make sure they have enough cash to meet their obligations on the daily basis, but the big one's capital. Okay.
And in England, you would be part of the Bank of Canada, Bank of England, wouldn't you?
Yeah, in the Bank of England, the central bank, Bank of England, has an arm called the Prudential Regulator, and that Prudential Regulator reports up to the Governor of the Bank of England. In Canada, we've separated financial regulators out, and so I am the de facto deputy head of the office. And the head of the office is the Minister of Finance.
It wouldn't appear that the Americans have anybody doing your job, given what happens to their financial sector on a regular basis.
Or they have 4 or 5. So in the United States, the Federal Reserve does have a supervisory arm, and they tend to focus on larger banks. The FDIC, or the Federal Deposit Insurance Corporation, they supervise banks. They tend to be medium-sized to smaller. And then there's another institution called the Office of the Comptroller of the Currency, and they supervise banks. So in some respects, the United States has a more fragmented regulatory system. And then you ask, well, why is that? In the history of our countries, Canada has always had a federal approach to banking. So banking has always been centralized in either Toronto or Montreal with branches across the country and regulated by the federal government. In the United States, up until very recently, the last 30, 40 years, banks were regulated at the state level, and they couldn't, in many cases, they couldn't move across state lines. So you have a much more fragmented system and a fragmented regulatory oversight. Ours works better. Our system works better. It produces less financial instability and more efficiency in banking and insurance.
Could what happened in the American financial system in 2007 happen in Canada? Could an institution get to the point where Fannie and Freddie were at without you knowing about it?
No. In the United States, really starting in the 90s and then into the 2000s, there were a few things going on. First of all, there was an ethic of deregulation. Let's get out of the way of the private sector, let the market regulate itself. That turned out to be a little optimistic, shall we say. In addition, there was regulatory fragmentation, and some regulators were competing against others. And how do you compete for business? You lower the cost of your product. Now, combined with that, you had a lot of private sector, quasi-unregulated activity that added to the mix and generally lowered standards for lending, particularly in the residential mortgage space. Why wouldn't that? And then we saw what happened. Why wouldn't that happen here? We saw that, and we learned some lessons and spent the last decade building in more protections. The easiest way I can explain why it wouldn't happen is talk about how we regulate the housing market, or rather the housing finance market, how people get mortgages. We have this guideline, and it's got a technical name. It's called B20, Residential Mortgage Underwriting Guideline. And what we do is we put in a whole bunch of very, very technical rules about or expectations about how banks should make mortgages, how they should appraise properties, how they should evaluate the creditworthiness of borrowers. And it's a set of just best practices for mortgage underwriting, and we write it down and publish it, and we say, these are the standards we're going to hold all the institutions in the country accountable to. Be smart about underwriting. Now, they follow them, hopefully, because we put them out there. But there's a more powerful force than that, and it's sort of the prisoner's dilemma. And the prisoner's dilemma: two prisoners in two different interview rooms, and they don't know what the other is going to say, but they know if they both have the same alibi, they'll get away. But because they can't hear each other, they don't trust each other, and they both wind up going in jail because they tell the truth. In banking, it's kind of the same trend, or the same phenomena. When we put a rule out that says, here's how we expect you to underwrite, then Bank A knows that Bank B is probably going to follow those rules. And so Bank A will follow those rules, and the same in reverse. And so what OSFI does in a lot of its work is sort of cure that prisoner's dilemma and raise underwriting standards. That in turn then means that when things do go bad, when we do have hard times in the economy more broadly, the system has buffers to absorb the shock of a downturn in housing or an increase in unemployment, or both simultaneously. That's really our job: cure prisoner's dilemma.
Well, to be honest, I thought about setting aside this ongoing story I've been telling about 5G spectrum, but then I decided no, I'm not going to do that, because I might never come back to it. It'd just sit there, unfinished, unfulfilled. And that, Herle Burlyites, is precisely the point of this next part of the story from our presenting sponsor, TELUS, about the best way to get high-speed 5G wireless connectivity right across our entire country, not just the big cities, but all rural, remote, and indigenous communities. This is Chapter 3, A Tale of Two Policies, or Why Set-Asides Must Be Set Aside. We've been talking about how the feds are holding public consultations on the best way to auction a new critical mid-band of 5G spectrum, which can carry reams of data over super long distances and will make connectivity so much faster. And last week I told you how 100 megahertz channels is the international standard for delivering the maximum benefits of 5G to customers. With a 100 megahertz caps policy in place, 4 different carriers like TELUS will have enough of that spectrum to launch their 5G networks equally in every market, which means they'll have to compete aggressively to provide the best service to their customers. Contrast that with set-asides. the other policy under consideration. Set-asides reserve a portion of spectrum, subsidized greatly, for regional carriers with healthy balance sheets who have not deployed the spectrum in rural areas where connectivity is needed. This isn't folly, it's fact. Historically, these regional carriers have deployed less than 20% of the rural spectrum they hold from previous auctions. Instead, they just sit on it, or they sit on it and wait until later when they try to sell it at a huge profit, which is known as spectrum speculation. Meanwhile, Canadians in those markets suffer. Herle Burlyites, it's the prime reason so many of our rural, remote, and Indigenous communities don't have adequate high-speed connectivity right now. So the way this new auction is conducted is critical to providing 5G access to every single Canadian household. And the best part is, you can have your say in the process by going to telus.com/get5gright. The story continues next week. There is so much innovation in the global financial world. It's just constant what the new vehicles that are being invented and new methods of transaction that are being invented. I remember back in the 90s, a senior Department of Finance official telling me that there were very few people in the world who really understood derivatives, and that none of them worked at the Department of Finance. How does your office keep up with that?
Well, specific for derivatives and for capital markets, we do have sector specialists who just focus on those risks. They're called market risk specialists. And their job is to figure out, for example, derivatives and other capital markets innovations. With respect to digital innovations, we have to build a team, or I should say we are in the process of building a team to begin to understand that. And the area where I'm beginning to spend a lot of my time on is the digitalization of money, whether you call it crypto or Bitcoin or stablecoin or decentralized finance. Those innovations are potential game changers, and the risk they present to the system is that they're largely unregulated. And we've seen what happens when a lot of really cool, unregulated financial innovations grow really quickly. We saw that in the United States in the 2000s in the residential mortgage housing market. We have to get obsessed with that issue in our system today. Interesting.
Okay, so let's start with one of the things people would be most interested to know. How stable are our financial institutions in Canada? We generally have a sense that they're extraordinarily stable. Is that true?
They are stable. I always avoid exaggerations when it comes to stability because I'm kind of paid to see the downside and prepare for it. So I wouldn't use the word extraordinarily stable. I'm quite confident in the stability, and let me try and explain why. We came through the last financial crisis quite well. We didn't have bank failures, and generally we're hailed as the world's safest banking system and financial system. We've probably increased the amount of capital buffers in there by 2.5 to 3 times. On top of that, it's technical. We've added a substantial block of contingent capital that'll, if there is the need, God forbid, of a quote unquote bailout, it'll actually be the private sector that funds that, not the public sector. We've done the same, probably doubled liquidity buffers. And the system is as profitable as it's been, and credit quality is as strong as I've seen it. So for those reasons, the system is very stable. And maybe stable is the wrong adjective. Probably the better adjective is resilient. So I can't promise you, David, or anyone in Canada that there won't be volatility. In fact, what I can promise you is what we've seen over the last 20 years, which is every 4 or 5 years, pretty significant bouts of volatility. That continues. Our system has a resilience to weather that. There will be bad years. There will be events where you think, wow, that's a lot of money for a bank to lose on credit, or for an insurance company to lose on bonds or equities. but the system has the resilience to absorb those hits in a way we haven't had before. And I'm quite confident about where we sit in the face of that volatility.
What do Canadians pay for that stability, Peter? I mean, we seem to have in this country, and I don't say this judgmentally, just observationally, created a group of about 6 banks for whom it is impossible that they would ever lose money, that they are in a certain type of highly protected oligopolistic situation that gives us real stability, but also presumably limited choice, etc. What do Canadians pay for the stability of our system?
Right. In general, the banks make very, very strong profit margins. And that comes from revenues that they charge their customers for their services. It varies by product. So, for example, in mortgages, we have quite competitive pricing for mortgages. The spreads on mortgage products are quite low, even compared to, say, the United States, where there is more competition. If you look into other product categories, and credit cards would be one, and not specifically the interest rates you pay in credit cards, but the interchange rates that banks and card networks clip off each purchase. Those are very high. ATM fees tend to be very high. And so what you have in an oligopoly is large players that take advantage of their competitive position and maximize their profit. To be honest, it is the way to get at that, the way to maybe add more value to Canadians and the financial services they receive, is to smartly and intelligently open up the system for a bit more competition, and digitalization offers avenues for that.
I want to get to digitization and crypto because there's a lot of interest, especially among the youngins, about that. But I want to talk first about housing.
Right.
I'm sure you're delighted to talk about it. Nobody ever asks you about it.
I spent 3 hours with the House Standing Committee on Finance, and we talked only about housing. So I'm quite prepared. What would you like to talk about?
Well, what's your role in the housing market?
Our role is to regulate financial institutions, but a great number of them make residential mortgage loans. And our role is to make sure they do that in a way that is sustainable and that leads to high credit quality in that system. And so by what do I mean by high credit quality? It means the people who get mortgages don't default on them. Or if they do, it's rare and it's easily handled.
OSFI created the stress test, right?
Yeah. And so the stress test is an example of a regulatory overlay on mortgage underwriting that all banks we expect to adhere to. And it adds a buffer in the system. And so, I'll explain what the minimum qualifying rate for uninsured mortgages is. If you go into a bank right now, you probably are going to get a mortgage rate of around 2.8 to 2.9 for a 5-year fixed. For variable, it would be 1.8 to 2. When your bank qualifies you for that mortgage, they're going to test your mortgage payments at a interest rate right now of 5.25%. And so that buffer is actually quite substantial. And the reason we want banks to do that is if something goes wrong, if we have an increase in rates or an unexpected event like loss of employment for one of the household members, that the household can absorb that. And it's worked fairly well. It's been in place for about 3-4 years. And mortgage delinquency in Canada is at an all-time low. So, it's at 0.17%, which is another way of saying that is there's 99.83% of Canadian mortgagors who are current on their mortgage. That's extraordinary.
So pretty soon, it'll be 2 years since we were all pulled into this whirlpool of a pandemic. 2 years. Remember the early scares? The toilet paper shortages, the sanitizer shortages, the job losses, the stock market crash, and rebound back in early 2020. People had no idea where it was all headed. And some fears were justified. Turns out those overseas supply chains we rely on so heavily are pretty fragile. But within North America, the fuel and the minerals and the manufactured goods and grain and the livestock and groceries and all the other things upon which our way of life depends have kept moving. Even the cargo from abroad that does manage to make it to our seaports reaches stores and consumers in timely fashion. And no company is more vital to keeping our domestic supply chains flowing smoothly than our sponsor, CN. If you've got it, a train probably brought it. From day one of the pandemic, CN employees have been reporting for work and keeping our economy moving. During those long months when the US-Canada border was closed to most of us, CN trains kept rolling and rolling on time, heading down through the American heartland to the Gulf of Mexico and back. They still are. Our weather is changing too, to put it mildly. Last winter was harsh, and we've already gone through a few tough months this winter. But you know, CN knows how to deal with deep cold and ice. The C in CN does stand for Canadian. Last summer brought disastrous heat and wildfires. Scientists are predicting more in the year to come. Ultimately, though, CN's trains will run on time. They simply have to. We all have plenty to worry about nowadays. Life is getting more expensive. Everything is more complicated. We still don't know where the pandemic is going. But when we do get to the other side, it will be because CN's trains helped get us there. That you can count on. Well, feel free to tell me that you don't have any role in this or that you don't want to have an opinion about this, but it seems since I've got somebody who's so integral to the financial system here, I need to ask them, what's driving housing prices?
So multiple factors. I don't mind answering that. We should always be asking exactly that when we think about the mortgage qualifying rate or bank regulation. There's several factors. There's a structural and then short term. Structural is thousands and thousands of really well-educated folks with financial resources want to immigrate to Canada and live here because it's a great country to live in. Household formation in Canada is very, very high, and probably the highest in the G7 on a population-adjusted basis. We're not building dwellings or housing units fast enough for household formation, and that puts a structural bid in the market that's very, very solid and tends to push prices up. Layer on that low interest rates. And a speculative boom in housing over the last couple years. So usually you'll see investors, folks or home buyers qualified as investors, make up 15 to 17% of home sales in a year. It's probably 22, 23 now. And even though that seems like a little bit, it's actually quite significant incremental demand into the system, which you layer on top of high interest rates, which you layer on top of structural tight housing market, you get what we've got, which is very, very rapid run up in prices.
It's become for a lot of players an investment vehicle more than shelter, right? I mean, this is now if you were thinking in Canada about where you'd want to invest your money to get the best return, you might not be thinking about an innovative new industry. You might not be thinking about a manufacturing company. You would most likely be thinking about real estate, would you not?
Certainly that's the case. I mean, empirically, that is the case over the last 2-3 years. There has been a speculative increase in buying power in the housing market. Is that crowding out other investments? Maybe a little bit over the last few years. Probably not going forward, to be honest. With rates going up, with the general recognition that, boy, housing is pretty fully valued, I'm not sure your expected return in the housing sector is, I think a smart investor would think twice and maybe look at other outlets.
Well, I'm trying to get at, Peter, where's all the money coming from? I mean, these prices, the supply argument that you made about immigration makes perfect sense to me. And John Webster made it on the on the
Yeah.
show too, and it makes a lot of sense to me. But it doesn't explain the run up in the last couple of years, which is obviously driven by some other dynamic. The incredible explosion of prices in them everywhere, but the major urban cities and then the exurbs. And I mean, to me, I don't know how people are still affording these houses and yet they're still being sold. So where is this pool of money to buy houses to pay, twice what a house cost last year?
Well, there's again, it's not a single thing. First of all, savings are up. House prices have been rising for a very long time, so there's a lot of embedded gains in home prices. So there's a source for the equity. Layer on top of that, a residential mortgage credit system that has extraordinarily low delinquency. And so if you're a bank and someone walks in and wants mortgage and your delinquency rate is 0.17%, you probably that's a pretty high quality loan. So credit's very available. Layer on top of that, interest rates are low. Layer on top of that, herd mentality around the speculative sector where folks say, well, I can get a quick loan. I have equity built up from my savings or maybe from my first house. I can go get a quick mortgage from the bank and it's not terribly difficult to get. I'll go buy this house down the road. Maybe I'll fix up the kitchen, do a little landscaping, slap a new paint job out front, and then I'll flip it 6 to 8 months. And there is a speculative fever that takes over private markets, and that's what's playing out. Looking ahead, it feels like we're at the latter stages of that phase. And my expectation is that as rates go up, assuming they do, some of that fever is going to abate a little and you'll see a slowdown in prices. In some markets where you had a really rapid increase in prices, you could see a fall of 10, 20% even. But that'll just be a return back to, I wouldn't say norms, but a return back to a little bit more sanity after a sudden buildup in prices. And by the way, we went through that in Vancouver in 2015, 2016, and then Toronto in 2016, 27. And you're talking peak to trough declines of 10 to 20%. So we can absorb that volatility.
What you were describing, though, is a closed loop in which people that have a house can buy a bigger house or can buy a second house or can buy a recreational property based on the equity in their home. But it's a closed loop that shuts out anybody that isn't already in the game with equity, right?
Yep.
What can be done? I've done research with people who ought to be middle class based on their demographics and socioeconomic status, who live in places like Vancouver and Toronto and don't think they're middle class because they see no prospect of themselves being able to own a home. And to them, owning a home is an essential part of being in the middle class in Canada. And we've got a whole generation of people growing up who don't appear to think they'll ever be able to own a home and are probably correct about that. What can we do to fix that?
To be frank, in the short run, it's difficult to fix that. In the short run, having prices correct down to levels where younger Canadians can jump into the housing market, that would be quite a shock for the system to absorb. And the underlying factors in the housing market, which is very strong demand due to household formation, aren't going away. I do think that as rates go up, you'll see some kind of normalization in prices, and that may make it a little more accessible, but that's not going to solve the problem. The longer term solve is to increase, there's a two-part answer to that. Bring up the construction of housing to a level that meets household formation. And that means you'll have more units or dwellings on the market that are affordable for younger Canadians. The second part is sort of somewhat cultural and has a bit of an infrastructure element. I think Canadians, if they want to live in big metropolitan areas, are going to have to get used to the notion that they may live in a smaller space. That that densification is the key to bringing up a supply and bringing prices into a level that's affordable. The 25 by 150 lot in central Toronto might not be a realistic expectation, especially if it's priced at $2 million. The market's telling you should probably have 2 or 3 units on that lot. And so we'll have to get used to living in smaller spaces. To use a word, it's the Manhattanization of our urban centers. And that's a cultural shift. And to affect that culturally, we need more infrastructure in schools, in public transportation, for commercial zoning. So when people live in an urban setting, they really benefit from being in close proximity to great commercial outlets. The Manhattanization is not a bad thing, and I think culturally we have to begin to accept that. I lived in New York for 7 years and lived in 700 square feet, which was a huge apartment if you were a Manhattanite. And it's a good life. I didn't have a car for 7 years. I took the subway and taxis everywhere. That's what the future of our cities.
But if you'd wanted a house, you'd have lived in Connecticut, right?
Yeah, Connecticut or New Jersey. Yep.
Yeah.
And had an hour and a half commute. I chose 700 square feet to have a half-hour commute. That's the future of urban living in Canada. Now, what's interesting coming out of COVID will Canadians have an opportunity to select housing outside those urban centers, but still do the great work that exists within them? And it looks like on all the evidence, the answer is probably a significant portion. Yes, you'll be able to do that. And that's part of the reason why we're seeing such a significant run up in house prices outside Montreal, Toronto, Vancouver, is that folks are realizing, hey, I can go live in Halifax and still do my Toronto job. Halifax house prices in last year are up 30%. Moncton, it's about 30%. Toronto, it's 15 to 18. So that's what our future looks like. Longer term, if the federal government can work with local and provincial governments in infrastructure investments and then to create zoning laws that will allow for densification, longer term we'll be able to offer the Canadian dream of homeownership to more Canadians earlier in their life.
But it will be a different home than their parents provided them with.
Yeah, you might live in a building or a multiplex, and you might live in 700 square feet instead of 2,100 square feet. But you walk out your street and your groceries are a block away and your favorite 2 or 3 restaurants are 4 or 5 blocks away. That's a great lifestyle. I lived that for a long time in New York and loved every minute of it.
One of the things I think is weird, because I grew up in Regina, which was sort of at least seemed to me to be relatively classless at the time. I don't mean with devoid of class. I mean pretty unstratified. And the person that the person that sold you groceries their kid might be in your school. Now we're heading to a situation where the people who service the economy may not live in the community you live in at all, right? So everybody from teachers to police officers to firemen to everybody that is the structural support commutes into this community and doesn't actually live in it.
Yeah.
Weird.
And that's part of the Manhattanization of our communities. That'll come with it. That will be something we'll have to adapt to. And for example, in Manhattan, the folks that I would see at the grocery store came down from Harlem or over from Queens. That's part of it. I think you see aspects of that in downtown Toronto or central Toronto today. The longer term solution is really intelligent, micro-targeted housing strategy that tries to blend different socioeconomic groups in closer proximity. We haven't really scratched the surface on that sort of local or urban policymaking, but it's worth pursuing, if only to lessen that trend, which is sadly pretty pervasive in urbanization.
Okay, so this is also depressing. Let's talk about something people are excited about. Crypto.
All right, crypto.
What the hell is it?
It's very complex and it's a brand new market. There are three basic forms of quote unquote crypto, or I like to call it digital money. The first is just cryptocurrency and stuff like Bitcoin. And all that is computer tokens generated by an algorithm that people attach value to. It's a store of value, and they trade it amongst each other. There is some evidence that you can pay with those types of what we call unbacked currencies, but it's pretty limited, and most of that activity is trading on exchanges, trading crypto tokens or cryptocurrencies against one another. Not really in the mainstream. Then there's something called stablecoins, which are cryptocurrencies tied to the Canadian dollar or the US dollar, tied to central bank money or fiat currency. And presumptively, those are backed by assets in fiat currency. And so therefore, one crypto coin, stable coin, is worth $1 Canadian or US. The third category is called decentralized finance, and it is a set of rules or protocols meant to disintermediate banks from complex capital market transactions. Those are the three categories. Cryptocurrency, Bitcoin, that market is about $2 trillion US. Roughly
That's real
Canada's
money,
GDP.
isn't it?
Yeah, roughly Canada's GDP. Stable coins are about probably 170 billion, and decentralized finance totals around 100 billion right now. But those are growing exponentially. So talk to me in a year, and that'll be up by 3 or 4 times.
So I'm 60 years old, Peter.
Yeah.
I'm 60 years old. I just got to stop you. I'm 60 years old, and the world is starting to pass me by. There's just no question about it, okay?
Yeah.
So why does somebody want to invest in an algorithmically derived token? Like, to me, there's something more than just rationality driving this crypto thing. There's some culture, there's some attitude, there's something that I don't have that makes other people want to create this. What are they doing?
Well, let me ask it this way. Didn't like a Wayne Gretzky rookie card just sell for something like $1 million? Piece of cardboard with a picture on it. I mean, he's a great player, and I loved watching him, but a piece of cardboard with a picture on it sold for something like $1 million recently. Why? Yeah. Why do these famous paintings sell for tens of millions? They're stores of value that everyone believes in. And so you've got this community of enthusiasts who believe a Bitcoin is worth whatever it is, $45,000 today. Why do they believe it? Because everyone else believes it. That is historically how folks think about stores of value. They don't think about necessarily the utility. Gold would be an example. This shiny metal in the ground that's worth thousands of dollars per pound. It's just a rock. Why is it worth thousands of dollars per pound, and has been historically? Because everyone agrees that it's a store of value. That's what's happening in crypto. There's a sizable community that believe it's worth that much, so it's worth that much. There's no social utility to it. It's just a store of value. Okay.
When you get into the realm of currency, of people who talk about using this as a currency, what are they trying to accomplish? What they want to get away from bank fees, bank charges, bank control, central bank control, government control. Who are these people?
So now we're moving out of the cryptocurrency towards stablecoin. They want to be unregulated banks, bluntly put. They want to create money, charge for it, and then make a profit, same as a regular bank. So let me try and use plain language to explain it. Everyone thinks that central banks create money. They do when their balance sheets grow, but mainly money is created by commercial banks. And the federal government gives the commercial banks a license to do that, and they employ someone like a superintendent who runs a larger regulatory arm to regulate those banks, to make sure they don't do it recklessly. And there is a closed or protected system designed to serve the broader economy. And it has costs and it's hard to get into. And if you want to get into it, there's all these big players that have all the share and it's hard to break in. Why not create something entirely new, create your own form of money, and then disintermediate the entire regulated system? That's fundamentally what, in my view, stablecoin is about trying to replace a financial system or replace the currency, the coin of the realm, with a different coin of the realm. And if you think that sounds dramatic, I would point you to the U.S. Presidential Working Group on stablecoins. Came out a paper that came out in December, and they said stablecoins should be regulated. If a stablecoin issuer should be regulated like a commercial bank, and they should be subject to prudential regulations and prudential oversight. And so what you're seeing there is the regulated system and the authorities responsible for overseeing it saying, no. If you're going to come in and create money, this thing called money that people use to transact, you're going to join the regulated system and you're going to be regulated for the purposes of long-term financial resilience.
Does that defeat the purpose?
It depends what your purpose is. If your purpose is to get rich by creating stable coins, yeah. If your purpose is to have a social utility like money that's well regulated and serves the broader economy and the broader national or international interest, then it doesn't defeat the purpose.
I mean, on balance, I've been asking these questions from a completely negative perspective, cynical, skeptical perspective. Leave all that aside. Are these things interesting? Do they have a utility either for people or for society?
Yeah. Our financial system is built on the financial system of the last 100 years. There is natural infrastructure and inertia in there. The digital technologies offer a way to overcome that inertia and to make the system more competitive and to bring more value to Canadians. My point of view is that should happen within a regulated perimeter. You don't get to exist, or you shouldn't be able to exist outside the regulated perimeter and disintermediate those that are providing services within the regulated perimeter. And so a big part of OSFI's analysis and work over the next several years will be, how can we widen the perimeter to bring more of these innovators in? And then let's let innovation come from incumbents who feel threatened by innovators. And then let's let innovation come from challengers who want to derive or build new products for Canadians that add value, more value than the incumbents. Let's let that competition produce more value. And so, to be honest, in our system in Canada, historically, we've valued very highly financial system resilience. And that tends to make it hard to get into the system. We have to think about ways to make it easier to get into systems for digital players and bring that competition in a way that doesn't undermine resilience. That's what we have to figure out over the next several years.
Interesting. Cool. Okay. Last thing we're going to have time to talk about, I think, is climate.
Okay.
And you have been working with the Bank of Canada on something I find fascinating, which is scenario-based risk assessments to the financial institutions. So you are running various scenarios for at what pace the earth warms and doesn't warm, and what actions are taken policy-wise to mitigate that, and running risk assessments against those. What are you learning? What scenarios and what risks are emerging from that exercise?
It's fascinating. That paper was sort of an aha moment in my first year as superintendent. We started with the premise that net zero 2050 is a reasonable expectation. That if we don't get to net zero by 2050, the costs to the global economy are so vast that the world will choose ultimately get to net zero emissions by 2050. So that's sort of your anchor assumption. okay, what's the pathway the world takes? Does it procrastinate for another decade and start in the 2030s and panic and move very fast? Do we start now and take a 30-year path? So our stress test was saying, let's look at what a 30-year more gradual adaptation looks like compared to a 20-year rushed adaptation. And what we found, it's a lot better for Canada if the world starts now and makes steady progress over 30 years, as opposed to waiting a decade and rushing. Within that, you will see the different impact. Well, let me put it this way. The scale of macroeconomic adjustment isn't different whether we choose 30 or 20. But it's pretty vast. You're talking to about 10 to 12% of GDP in Canada. We have to find a way to run parts of that GDP down and then build up other parts in order to adapt to net zero 2050, an exogenous force. Within that, and so that's just the economic adjustment will be easier to manage if the world starts now. When I think about financial system stability, what does that mean? It means, look, we don't control the pace at which the world moves to 2050. But there's at least a reasonable possibility that we take the procrastinated, delayed start approach. And therefore, the economic shock is greater and the shock to the financial system could be greater. And so our job today is to start building the resilience in the system to absorb a shock in the 2030s. So when we talk about climate at OSFI, it's a right now issue. It's not a 2050 issue or a 2030 issue. We need to begin to build the resilience so that the financial system can absorb wherever we are from 2030 to 2050. That's the big task.
When you talk about that, about what the financial system can absorb, are you referring to the fact that the fight against climate change, getting to net zero by 2050, whether it's oil and gas or mining or forestry or agriculture, wipes a tremendous amount of wealth creation off the Canadian map? And we are a poorer country as a consequence. And therefore, there's risk to our financial sector. Is that what you were talking about?
If we do nothing, you're right. I mean, if the world uses less oil and gas, they're not going to buy as much. And so some of our GDP comes from export of oil and gas. If we do nothing, that's correct. We will not do nothing. We will adapt. I mean, Canada is a fairly resilient, adaptable, free country. I'm not worried about that. I'm not worried about our innovative capacity. But I'd like to take 30 years to do that rather than 20. But I have to be prepared for a world where all of a sudden events or demand shifts are hitting the country in a way that is more abrupt. And the financial system has to be there to manage it and manage it well. So, and that comes to I think the next logical thing is that, all else equal, would be better to begin to think about what sort of innovation and adaptive capacity Canada needs now to lessen that problem in the 2030s and 2040s. Yeah, that's not an OSFI issue. That's a federal government issue. We can be supportive and constructive in terms of figuring that out, but that is a major shift in how we think about the wealth that Canada creates. The good news is hundreds of thousands of folks who are really smart come to Canada every year because they want to live in relative security and freedom. That's our edge. We'll figure that out. We have the entrepreneurial and innovative zeal already here, and more is coming every year. So I'm quite optimistic we'll figure it out. I just hope we start now.
Right. And in terms of also starting now, do you play any role? I mean, there's these people, I know it through Mark Carney, but I know that there are a lot of people working at galvanizing global finance towards solving the climate change problem, getting investment geared toward the right things that will do that. Do you play a role in that?
We play an indirect role in that as banks globally and insurance companies globally begin to price in climate change onto their balance sheets, begin to revalue assets on the basis of climate change expectations, progress towards what we just talked about will speed up or slow down. The question we have to figure out is, do we put our thumb on the scale for speeding it up, or do we just stay entirely risk focused? It's probably too extreme a depiction of that issue. What we have to do over the next, so leave aside the building of capital and resilience for the 2030 problem. We have to be innovative in thinking about how we look at risk, investment risk, business risk, lending risk in our system in the face of climate change. And that means that we have to be more creative in how we think about credit risk or market risk. And what do I mean by that? Historically, when we look at credit risk and market risk, and we make rules on the basis of managing that risk carefully, we look backwards. We look at history. There is no backwards or history for climate change. And so we've got to find a way over the next 5 years to 8 years of building in more forward-looking risk evaluations into how we ask our banks and insurance companies to capitalize their businesses. And we're just starting on that, and it's going to take hopefully 5 years, but it could go longer than that. That's the
so banks have to look deep into the portfolio of the people they're lending to and assess whether they have properly taken into account the climate risk to their business. Is that right?
Yeah. So a bank that makes a loan to an oil and gas company will have to say, well, how long realistically is that revenue stream going to be there? And whereas before you might thought, well, it's indefinite as long as they stay competitive. Now you think, well, there's a finite end to that. All right, that's part one. Part two is, what are they doing to adapt their business model to renewable or alternative energy sources? And maybe those innovations aren't as risky as they might have been a decade ago. And maybe staying the course is more risky than it would have been a decade ago. We have to find a way to trigger or aid that thinking at the bank level, and we can do that through our capital requirements. It's just not an overnight thing. It's going to take us a while.
Yeah, well, it seems really important because, to be honest, I don't really talk to anybody that convinces me that we're going to get to net zero by 2030 without major technological innovations.
No. It's a significant adjustment for the global economy, and because we are a natural resource exporter, it's a significant adjustment for Canada. I don't think we control net zero 2050. I just think it's something we have to adapt to, and better to start now.
Peter, this has been fascinating. I've learned so much from you today. Thank you for taking the time to do this. I just want to mention, though, we have a section on the Air Quotes Media website called Quotes, where people occasionally make contributions to public policy in written form. And in conjunction with this conversation, you've written a piece for Quotes, which I'd encourage people to go to the airquotesmedia.com website and read that. Do you want to give us a quick synopsis of what that's about?
Yeah, what we try and lay out is a lot of what we're talking about today, that we've had this resilient financial system that's weathered enormous volatility over the last 20 years, this century. We can't be complacent. We have to face the horizon, look at these risks on the horizon, and start to adapt to them. Within OSFI, that means we're going to transform ourselves and organize ourselves against getting after those risks, and we'll look different. In terms of how outsiders might look at OSFI, they'll see an OSFI much more focused on digital issues, much more focused on climate transition issues, and hopefully much more transparent and sensitive to public policy issues that we have an impact on. For example, housing. We know the decisions we make around housing affect hundreds of thousands of Canadians every year. We'll get better at talking to Canadians about that and with listening to Canadians about that.
Terrific. Thanks, Peter. OSFI, the Office of the Superintendent of Financial Institutions. Have an unassuming name, undecipherable name, and carry a big stick. That's the Peter Routledge message. Thanks for coming on. Thanks for contributing the piece. And it was really great to get to meet you virtually like this. Thanks a lot.
Thank you for this podcast. It's a great contribution to the Canadian political discourse. So well done, and I'll keep listening.
Super. All right. Thank you to our presenting sponsor, TELUS, and to our sponsor, CN Rail, and to all you Herle Burlyites. We'll be back next week. Thanks very much.